Most super mistakes don't feel like mistakes. Nobody makes one big dramatic decision and watches it blow up in real time. It's quieter than that. You retire, you get on with your life, and somewhere in the background, something you never even knew you were supposed to do just doesn't get done. And it costs you, quietly, every single year after. Right now, there are roughly 700,000 Australians who've retired and are still paying tax on super they don't need to be paying, not because they did anything wrong, but because they assumed something would happen automatically. It didn't. That's mistake number 1. There are 5 in total, every one of them specific to the years after 60, and every single one is fixable. Stick around for the 5th one especially. It's the one nobody talks about, it's the most expensive of the lot, and there's a window to fix it that slams shut at 75. Quick note before we dive in. This is general information, not personal financial advice. The rules change and your situation is your own, so treat this as a starting point for a proper conversation with your fund or an advisor, not the final word. Here's the mistake that catches the most people out. You retire, you've met a condition of release, and you assume your super automatically shifts into what's called a retirement phase. It doesn't. Nobody moves it for you. Your fund won't do it on your behalf, and there's no letter that magically shows up telling you to sort it out. Your money just sits exactly where it was, in your accumulation account, quietly getting taxed at 15% on its earnings, the same as when you were still working full-time. Move that same money into what's called an account-based pension, though, and those earnings become completely tax-free. Same fund, same investments, same money. The only thing that changes is which account it's technically sitting in. The Super Members Council puts the average cost of getting this wrong at around $650 a year. That's the average across everyone. If your balance is on the higher side, it's comfortably in the thousands every single year that it's left sitting there. The fix takes one phone call to your fund. That's genuinely the whole thing. If that's news to you, do me a favor and hit like. It's honestly the fastest way to get this in front of someone else who's sitting in accumulation phase right now without even realizing it. And while you're there, subscribe. I put one of these out every couple of weeks for Australians who'd rather understand the rules up front than find out the hard way later. I covered transition to retirement pensions, or TTRs, in an earlier video, and this is exactly where they trip people up. A TTR lets you draw an income from your super while you're still working, genuinely useful, but the earnings inside a TTR are still taxed at 15% because a TTR only sits on a partial condition of release, not a full one.
Here's the mistake. Some people start a TTR when they've actually already met a full condition of release, without realizing it. And here's the bit that catches people out. Ceasing an employment arrangement after age 60 counts as a full condition of release. So if you finished a job at 61, even if you started somewhere new the following week, the super you'd built up to that point is fully accessible. If that's you and you started a TTR anyway, you've locked yourself into 15% tax on earnings when you were actually entitled to pay 0. It works in reverse too, and this one's worth knowing. If you're already running a TTR and then you stop work, get made redundant or change employers, that can convert your TTR into a full account-based pension and switch the tax on earnings off entirely. But it doesn't always happen by itself. If your working situation changes and you've got a TTR running, ring your fund and ask exactly where you stand. This one is pure paperwork, and it's brutal precisely because it's completely avoidable. If you make a personal contribution to super and you plan to claim a tax deduction for it, you have to lodge what's called a notice of intent to claim with your fund. It's a specific form and the timing matters enormously. You have to lodge it before you start a pension with that money and before you roll it over to another fund. Get the order wrong and it can be too late. The deduction is simply gone. This one catches people right at this stage of life because so much tends to happen at once around age 60. You're making a final catch-up contribution, consolidating a couple of old funds, and starting a pension all within the same few months, and the notice of intent gets lost in the shuffle. If you're planning a big contribution and a pension start in the same financial year, get the sequence right. Contribution first, notice of intent lodged and acknowledged by your fund second, pension third, in that exact order. Quick one for the comments. Has your super fund actually explained the notice of intent form to you? I genuinely want to know how common that is, because I suspect the honest answer is almost never. This one only affects couples, but when it bites hard. Before you reach pension age, super sitting in an accumulation account is generally invisible to Centrelink's income and assets tests. Start an account-based pension though, and it stops being invisible. That balance instantly becomes accessible. So picture a couple with a bit of an age gap. One partner is 68 and already receiving the age pension. The other is 63, has just retired and starts a pension, because everything covered so far in this video says that's the right move. Usually it is, but in this case, a balance that was completely invisible to Centrelink has just landed squarely on the household means test, and the older partner's age pension can drop or stop altogether. To be clear, the lesson here isn't never start a pension. Often you're still genuinely better off overall. The mistake is running the numbers on one person's super in isolation when Centrelink assesses couples together. If there's an age gap and one of you is already on the pension, model both outcomes properly before you press go. This is a genuinely good moment to pay for an hour of professional advice. Nobody enjoys this conversation, which is exactly why it so often doesn't happen.
Your super is made up of two components: a taxable component, everything that went in as employer contributions or salary sacrifice, and a tax-free component, which is money you personally contributed after tax without claiming a deduction. For most Australians, the overwhelming majority of the balance sits in the taxable component. If your super goes to your spouse when you pass away, there's no tax. But if it goes to an adult child who isn't financially dependent on you, and for most families that's exactly where it ends up going, they'll pay 17% on the taxable component. That's $17,000 for every $100,000. Here's what turns this from bad luck into an actual mistake. From age 60, you can withdraw from super completely tax-free, and you can keep contributing until age 75. That creates a window, and only in that window it's possible to withdraw money and recontribute it, so it comes back in classified as tax-free component. Handled carefully over a few years, a large taxable component can be meaningfully reduced. Handled carelessly, you can breach contribution caps and trigger real penalties. This is genuinely not a do-it-yourself job. The window opens at 60 and closes at 75. If you don't know it exists, you'll simply miss it, and your kids will quietly pick up the tab. While we're on it, go check your beneficiary nomination. Your will does not automatically cover your super, and binding nominations lapse after 3 years unless they're specifically set up as non-lapsing. Two more things, and one of these matters to more of you than you'd think. Division 296 started on the 1st of July this year. If your total super balance sits above $3 million, an extra 15% applies to the earnings attributable to the portion above that threshold, and 25% on top of the base rate for the portion above $10 million. It only counts realized earnings, not paper gains, and the threshold is indexed. For most people watching this, it isn't your problem, but if you're anywhere near it, the first assessments land after June 2027, so there's time to plan. The second change is bigger for far more of you, even though it isn't a super change at all. From the 1st of July 2027, the 50% capital gains tax discount is being replaced with cost basis indexation and a minimum 30% tax rate on gains, and negative gearing is being restricted for established residential properties acquired after that policy was announced in May this year. Properties already held are largely grandfathered in under transitional rules. Here's why that matters in a video about super. Superannuation is not affected by that change at all. The tax concession that applies to growth assets held inside super stays exactly as it is. So, from July 2027, the gap between holding a growth asset inside your super versus holding the same asset in your own name actually gets wider, not narrower. If you've been thinking of super as the place your money gets stuck, this might be worth reconsidering. 5 mistakes. Assuming retirement moves your money for you. Starting a TTR when you'd already qualified for something better. Getting the paperwork sequence wrong. Starting a pension without checking your partner's position. And leaving behind a taxable component your kids will end up paying tax on. Not one of these is about picking the right investment or timing the market. Every single one is just a rule nobody told you about. So, tell me in the comments, which of these 5 did you not know about? You don't need to write an essay, just drop the number. 1, 2, 3, 4, or 5. I read every comment and they genuinely decide what I cover next. And if you haven't seen it yet, the video on whether you can actually retire at 60 covers the conditions of release I mentioned in Mistake 2. It's on screen now. Thanks for watching. I'll see you in the next one.